everyone, welcome back to the show. My name is Mike, this is my whiteboard, and today we're going to be covering the adjustments for the covered put. So yesterday we talked about the trade checklist for the covered put, so we talked about what might happen if the stock goes up, down, or sideways, what the trade actually is, how it's a little bit and basically the opposite of a covered call, and we talked about some helpful tips when we're looking to enter that trade. But today we're going to look at that adjustment series. So we're going to really dig into what we might do and give specific examples when the trade or stock price goes up, which would be bad for us, goes down, which would be good for us in this scenario, or stays the same, and what we can do to continue to reduce our cost basis. So let's go to the first slide and we'll review exactly what this trade is. So when we're looking at a covered put, we're basically selling 100 shares of stock and we're selling an out-of-the-money put below that stock price to help reduce our cost basis. So it's literally the exact opposite of a covered call where we would be buying 100 shares of stock and selling an out-of-the-money call. So here we're looking at selling 100 shares of stock and selling that out-of-the-money put. So let's say we've got a 45 days till expiration time frame and we're looking at selling a put at the 75 strike for $1.25. So just like the covered call, we calculate the max profit in the exact same way. Basically what we do is just take the difference between our stock price where we sold these shares and calculate the difference between the strike price there. So I sold the shares here at 80 and the strike price is at 75. So that has 5 points of value. And since I'm collecting an additional $1.25 here, I add those two together and that gives me my max profit of $6.25 at expiration. So even if the stock price is well below here, I'm going to be right around that max profit of $6.25, or ideally if the stock price is right at 75, I'm going to see that profit in the shares because I sold them at 80, I'm going to be able to buy them back at 75, and I'm going to be able to collect that full premium of $1.25. The difference here with max loss when we compare this to a covered call is that it is actually unlimited. With a covered call, we're looking at buying 100 shares of stock, which means the shares cannot go below zero. No stock price can go below zero, but there is no cap to the upside of where a stock can go to. You look at something like Priceline or Amazon or Google, they all started somewhere and now they're exponentially higher. So when we're looking at max losses for a covered put, since we're selling these shares of stock and we're selling them at the 80 level, the stock price can go infinitely higher. There's no cap to where an underlying can go, and for that reason our max loss is unlimited here. But since we're selling premium, our break even is going to be improved. But like I talked about yesterday, when we're normally looking at selling premium, we're normally looking at taking the stock price or taking our strike price and subtracting the premium we receive from that level to calculate where our break even is. But since we're looking at selling shares of stock, we're actually going to do the opposite. So we're going to be looking at selling shares of stock, and I know that my losses are going to be to the upside. And as we know, when we're selling premium, we're going to help ourselves move our losses in our favor. So since that is true, when I'm looking at moving the break even here, I'm actually going to be looking at the 80 mark where I sold these shares, and I'm going to move our break even by the amount of the premium I received from selling that put. So my break even is not going to be at 80, it's actually going to be at 81.25 since I've sold $1.25 worth of premium to help offset any losses. Because at the end of the day, if the stock price moves up to 81.25, I'm going to see a $125 loss on the shares alone. But since I collected $1.25 of premium and that's going to expire worthless out of the money if the stock price is up here, then that's going to help me offset that, and it's going to offset that entirely. So I would see $1.25 of losses on the shares, but I would see $1.25 of gain from that short put, which brings me to a P&L of 0. So let's go to the first example here, and we're going to talk about what will happen with the stock price decreasing. So I've got the dollar sign here because this is exactly what we want to happen when we're looking at a covered put scenario. It is a bearish strategy because we're looking at selling 100 shares of stock, which means we're going to want to buy it back at a lower price to realize those profits. So the stock price decreasing is exactly what we want. So I've got the exact same scenario that we just talked about on this first level here. So let's look at the lower level if we just look at that here. So we've got our shares at 80, that's where we sold them. And let's say the stock price actually goes down to 75. So there's a few things that we can do. Let's say it's the end of the trading cycle, so I've got 0 days till expiration. It's the last day that I can make any sort of adjustment or close this position. But instead of closing the position, I want to actually hold on to these shares, and I'm still bearish on the underlying. So I'm going to look to close out of my 75 strike that I originally sold and basically sell a new one in a new expiration cycle here. So let's say that there's 0 days till expiration. This put here is worth 5 cents. So we're really coming up to the last seconds of trading, and I'm able to close this out for 5 cents. The very first thing I need to realize is that I'm not collecting that full $1.25 because I'm paying 5 cents to close out of that position. So when I'm looking at my cost basis and my break even and my realized profit, I need to take that into consideration. Just because I sold this for $1.25 does not mean that I've profited fully by $1.25 here, because I'm actually paying 5 cents to close out of that position. But I'm still fine with it because $1.20 is just as good as $1.25 in a lot of scenarios. So here we're going to look at the calculations. So my break even, my new break even is going to be at 82.40. So originally it was at 81.25. Now I'm buying this back for 5 cents, which reduces my break even by 5 cents. But I'm collecting another $1.20. So I just add those two together. So basically the $1.20 net profit that I realized from my original trade and my new $1.20 that I'm selling from this 70 put. So I take $1.20 and $1.20 and I get 82.40. I'm basically just adding that first $1.20 to the upside and adding another $1.20 to the upside here, because well, again, when we're looking at a covered put, the cost basis reduction is going to be realized to the upside since we sold those shares. So it's really important to keep that in mind and remember that. The realized profit is going to be $520. So I sold the shares at 80, they're now at 75, and I was able to capture a net profit on my short put of $1.20. So I'm just taking the difference between 80 and 75, which is 5 points or $500, and I'm adding in that $1.20 net profit from that put, which gets me that realized profit here of actually $620. My new potential profit is going to be $620 as well, because of the fact that I'm now at 75 and I'm looking at selling a new put at 70. So I'm again taking the difference between 75 and 70, and I'm looking at the new $1.20 that I'm collecting in premium. So if I get the best case scenario here where I'm able to have the stock price go even further down, my new potential profit is going to be $620, which would be great for this position. So let's go on to the next slide and we'll talk about the opposite scenario when the stock price actually increases. And when this happens, this is actually the worst case scenario, which is why I've got this big red X here. So let's say the stock price increases. So we've got our standard position. We're going right back to the drawing board of where we sold our shares. And let's say the stock price goes up to 85. And we've got 10 days to go. And we're really looking to just move this trade on, maybe collect a little bit more premium, which is exactly what we're going to do here. So let's say we've got our shares at 85. We originally sold them at 80. So right there, I know I'm going to see a $500 loss on the actual shares. But since I collected premium, let's say I collected $1.25 like we said, but I'm closing out of this put at 75 for 1 penny, and I'm actually going to roll it to a new expiration, as you see here, with 30 days to go. I'm going to roll it up to the 78 strike, and I'm going to collect another 60 cents in doing that. So my break even is going to be 81.84 here, because I'm taking into consideration that 1 penny that I paid and also the additional 60 cents of credit that I'm taking in. So my original break even from this trade here was 81.25. I'm paying that 1 penny, which brings me down to 81.24, but I'm collecting an additional 60 cents, so I go from 81.24 all the way up to 81.84. So that's how I calculated that there. So my current loss is going to be $316, or what I'm going to see, especially after I collect this 60 cents. So if the stock price stays right here and this new expiration or new put in that expiration of 30 days expires completely out of the money, I'm going to see a realized loss of $316. I would have collected a total of basically here $1.25 plus 60, so $1.85, but I did pay that 1 penny, which brings me down to $1.84. So basically you take that $500 loss that I'm seeing on the shares, you subtract $1.84, and that's where you get our current loss of $316. So we would see a realized loss of $316 as opposed to $500 if this new put we sell expires completely out of the money. So when we compare $500 loss to a $316 loss, obviously the $316 loss is a much better situation that we put ourselves in, even if our trade goes against us. So that's why we always look to reduce our cost basis, and especially with these positions where we're getting pretty aggressive in rolling the short put up to collect more value, because I'm almost cutting my loss in half. If I would be collecting a little bit more premium where I would bring my loss down to $250, I would have literally cut my losses in half just by selling these puts, as opposed to just selling the shares outright. So that's why we always look to reduce our basis by selling this premium. But if I actually have this trade go for me now, if I've got my strike here at 78 and I'm going to see a new potential of 384. So basically all I'm doing is just looking at where my current position is, where my break even is. So if I know that my break even is at 81.84, that's going to be right about here, then that means anywhere further down is going to be profit potential. So my break even is at 81.84. It's including all of the premium I've already collected, which means that if I'm at 81.84 break even and I've capped my profits at 78, the difference between 81.84 and 78 is just $3.84 or $384. But let's go on to the next slide and we'll talk about what happens if the stock price stays the same. And this is really another great scenario for us because we don't need the stock price to move when we have premium selling on our side. So if I were to have just sold these shares outright, I would definitely need the stock price to decrease to make money, because if I sell the shares here, I need the shares to drop in value to be able to buy them back at this level, which gives me that profit potential there. But if I'm selling premium, I don't need that to happen. So I've got that standard trade here. We're going back to square one. And let's assume that 42 days have passed. We've only got 3 days left to go. And the stock price is right back where we originally sold it. Well, there's a few good things. Number one is that I know that my put is going to be worth a lot less value because all those days have passed, so there's not much time left. So there's not going to be a lot of value in that position. So let's say I'm able to buy back that put for 5 cents, which means I've locked in a realized profit on that put of $1.20 or $120. And that's a great thing considering the stock price is right where it was when we originally sold it. If I didn't sell that put, I would have just been at break even, which is why we always look to reduce our basis. And let's say I still want to keep the dream alive. I've still got a bearish assumption on this underlying. So let's say I deploy a new trade, a new $1.25 put in that 43 days till expiration range. So my new profit potential is going to be $625 because if the stock price is at 80, I'm selling another put at 75 for $1.25. I just take that 5-point differential there and add in that premium. That gives me that $625 potential profit there, and my break even is going to move even further. So originally I sold my put for $1.25, bought it back for 5 cents, so that's a net profit of $1.20 that I can use to calculate my break even. So my break even would be at $81.20, but now I'm collecting another $1.25, which brings me to $82.45 there. So the more premium I collect, the farther my break even is going to move to the upside, which number one means that if the stock price doesn't move at all, I'm able to profit to that point. But if the stock price does move against me, I'm able to break even much further up here, the more credit I collect than if I were to have not sold any premium in the first place. So let's wrap all this together with some takeaways for you. Very first takeaway here is that really with covered puts, we need to understand that we are selling shares of stock. We're not buying them, so we're not theoretically capped at that 0 mark like we would be with a covered call. We do have unlimited loss due to no cap being on the upside of a stock price. Like I said, if you look at Priceline, I believe it started trading around 20 and now it's in the thousands. So take a look at something like that and really understand what we're getting into when we're deploying bearish strategies like this. And when it comes to adjustments, it's all about that cost basis reduction. Like I've shown you, whether the stock price moves against us or if it doesn't move at all, if we're continually reducing our cost basis, we're able to put ourselves in a higher and higher probability of success. And lastly, when we are maneuvering, keep in mind the probability of profit and break-even price. So when I moved up that short put when the stock price went against me, I was very cognizant of my break-even, and I made sure that I did not move my put further than my break-even price, because if we do that, we can lock ourselves into a loss. So I'm usually very aware of where my break-even is, and I won't exceed that with that short option to make sure that if the stock price actually does come back down, I'm able to profit or at least break even. So thanks so much for tuning in. This has been the 3 covered put adjustments. If you've got any questions or feedback, shoot me an email here, or you can follow me at DoTraderMike on Twitter. Stay tuned though, we got Jim Schultz coming up next.